Welcome to the Startup Grind.
Boris. So this is Boris Wertz. He's one of the top tech early stage investors in North America. He's invested in several companies that have had some pretty big exits. A couple of them going to Google and Twitter and Salesforce. He graduated from management in Germany, and since then he has started Just Books, which was then acquired by Abe Books, and then it was sold to Amazon in 2008. And he's now the founding partner of Version 1 Ventures, which is a venture capitalist firm here in Vancouver. And they are just starting their first stage of Series A funding for early stage tech startups. So, welcome, Boris.
Thank you. Perfect.
Great.
Sounds more complicated than it actually is, but no.
Try to give it brief.
Thanks for having me.
Awesome. So we'll get started. Just a couple questions here. So you graduated from the Management School of Business in Germany. What did you do after that?
So I did what a lot of people in Germany do is I did a PhD in actually logistics, which is something that I haven't really touched since. Because what we did after the PhD was creating a marketplace for used for out of print books, which was basically kind of a mini eBay for hard to find books. But we never touched the book. We never really saw the books. We just connected buyers and sellers. So it was kind of the joke, because we all met at the university doing our PhD that in logistics, that we then created a company that had nothing to do with logistics, and it was kind of a virtual connection between buyers and sellers.
Awesome. So while you were there, did you always know that you wanted to be an entrepreneur, or was that something that kind of came later?
You know, I always knew I wanted to be an entrepreneur at some stage, but it's about these opportunities that you suddenly see and you suddenly kind of go for it. My big moment was in '99, and for the people old enough in this room to remember that, was kind of Web 1.0, big internet bubble, and parties all over the world. It was a crazy time, and I just finished my PhD and was on a trip in Vietnam, and lay in the hotel watching a little bit CNN, and suddenly I see this headline: eBay buys German startup for $75 million after 3 months after it got started. It's like, that's crazy, and it was, especially was started by some people that went to university with me, and so I thought, like, wow, it looks something is going on here. So I had already signed on for a job to become the CFO of a telecommunications company. And I went back to Germany after the trip, and basically told the people I wouldn't start my job, and I would become an entrepreneur. So we got together in a team and discussed a few ideas, and just went for it, and got lucky, got funding, got traction, and it went from there on. But while I always had kind of the idea and the dream to become an entrepreneur, kind of the concrete decision was pretty quick, emotional, and taken based on some other people doing some pretty amazing things, and I thought I wanted to be part of that.
Awesome. So that was Just Books, right?
Yeah.
And that was your first startup?
Correct.
Awesome. So can you tell us a bit about that experience when you started Just Books?
So we started Just Books in '99, and very different times. Again, Internet 1.0. You had a business plan. You looked somehow smart. You found an angel within 4 weeks, and they gave you $1 million, and then 3 months later it was worth $10 million, and you kind of you thought you were super rich, and everybody felt super important and super famous, and no PR agency worked fast enough for these really important founders. So anyway, it was a really, really crazy time, but burst pretty quickly. In 2000, 9 months after we had raised money, the whole internet bubble burst, and it was what people call the nuclear winter. There was just no money at all that could be raised anymore. And we got really lucky that we had built up a pretty good business in Germany, France, and the UK, became the market leader in Europe. And a Canadian company approached us, Abe Books, out of Victoria, BC, and they had bootstrapped to become the North American market leader in that space, and wanted to expand to Europe, and they they bought us, which was a really good time to be buying us, because we were very close of running out of money. So we got lucky, and they bought us in 2001, and we became kind of part of a bigger entity.
Okay, so that was the driving factor as to why you sold to A-Books?
Yeah, I mean, there was not much choice at that stage.
And your partner was on board with that as well?
Yeah, I mean, we were 5 founders that started Just Books. At the time, we were still 4, so from that point of view, I think it was pretty emotional to sell the company, but again, I mean, there was just no other option left at that stage.
What would you say to companies now who might be considering selling to a company like A-Books?
You know, it's I mean, selling is always a really tough process. I mean, the first one, it's your baby. You work really hard to get it to a certain point, and now you're kind of giving up control. There's, you know, all of the potential upside that there is. I think there's no real good rule of thumb. I mean, my general feeling is, you know, leaving out kind of the situation where you just don't have any option at all. I mean, if you're with your back against the wall, then you have to sell. I mean, it's not even, you know, something up for a decision. That was definitely kind of what we had, the situation we had at Just Books. But overall, I feel like as long as you as a founder have still tons of ideas how to grow the company, how to take the company to the next level, don't sell. I think there's still way more value that you can create, and I think that's exactly why we sold later on to Amazon. We reached that point where we just didn't have any big ideas anymore how to take the company to the next level. You know, we had to build a $40 million business, 140 people worldwide. We had optimized the business model. We had tried to expand into other products, which didn't really work. We expanded into new books besides the hard-to-find books, and it was moderate success. We had internationalized to 6 countries. What was left was only really risky countries like, you know, China and Japan and Korea. We had bought companies up and down the value chain to kind of extend our reach. And we basically had run out of ideas to really create a really big company. I mean, even kind of the path to $100 million wasn't quite clear. It was still, you know, it was a super profitable company. It was growing 10-15% year over year. So, you know, really solid company. But we just didn't know how to, you know, create $1 billion company, even a $100 million company. That was the point where we decided, you know, it's time to really sell the company, and to sell it to somebody that saw more value and more upside in the company that we saw.
Yeah, for sure. And when you did sell to A-Books, how was that transition? Because you moved here for that reason, and then you were then working for a company that now owned the company you were running, right?
Yeah, I mean, I definitely, you know, as you know, I still had a relatively large stake in the combined entity because we sold for stock, not for cash. But still, I mean, I wasn't the founder anymore, right? And I was more kind of an employed manager with a large equity stake than I felt like a founder. At the same time, you know, for me, it was a tremendous experience. You know, over 8 years from starting a company and, you know, setting up IKEA desks to get the office ready and painting walls and stuff like that, to in the end co-running a company of about 40 million revenues. You know, I had over 80 people reporting to me, so it was, you know, pretty sizable operations, and with all of the good things and the bad things that come with that. But it certainly gave me tremendous amount of perspective on what it takes to scale a company and the different phases you go through, from the early stage of a tiny startup that tries to find product market fit to kind of a medium-sized company that has all sorts of, you know, organization challenges and HR challenges and so on.
What was the biggest lesson that you learned from taking that like tiny early stage company to selling it to A-Books?
Have really good partners as co-founders. It's just I think when I look at these 8 years, and it really doesn't matter what stage it was, you have tremendous ups and downs all the time, right? And you know, in the beginning, it's probably more kind of panic: will you make it, and will you survive? And then later on, it's perhaps frustration with, you know, people that you hired, or partners that, you know, suddenly drop off, or the numbers that don't really develop in the way that you want them to develop. So there's tremendous ups and downs, and the only thing that can really help you through that and pull you through that is very good co-founders that when you're down, they're up and pull you to the next stage. It's a tough business startup, right? And great co-founders help ease that pain.
Thanks. So you left AbeBooks when it was acquired by Amazon in 2008. Why didn't you stay on to work with Amazon?
Amazon is a great company, and they have been a super owner of AbeBooks. I think everybody that stayed on has been extremely happy. They still run it as an independent company, still based in Victoria. So they, I think they only got the best out of it. But for me, it was about two things. The first one was, I felt like my learning curve had flattened quite a bit. The business wasn't growing tremendously, and it felt like I wasn't adding as much knowledge anymore, kind of staying on there. And if there's one thing I kind of learned in my career is always, find platforms where you learn a tremendous amount of new stuff in a very short time, either from peers or from bosses or from an institution, whatever it is, and just had reached that point where AbeBooks wasn't that platform anymore. And then the second thing, Amazon put some nice golden handshakes on all of the employees for at least 3 years, staying on at least 3 years, potentially 4 years, and it felt like another year would have been okay. 3 years, 4 years felt like it was a long period of time, and when I had already kind of reached the conclusion that I wanted to do something else. Yeah.
So then you became an investor, an angel investor, right?
Yeah.
And what made you so passionate about helping early stage startups?
I think the original thesis was I want to kind of switch to the other side and help other people build and scale startups and not run it myself. But at the same time, I wasn't quite sure if I was any good at it, and it's a tremendous change from being an operator entrepreneur to an investor. As an entrepreneur, you're the eternal optimist that always sees opportunities. As an investor, you need to be the eternal pessimist that sees all the things that can go wrong, right? As an entrepreneur, the wins are your wins, the losses are your losses. As an investor, the wins are not your wins, and they're kind of, and the losses are not your losses either. So it's a complete different emotional roller coaster that you have. So it's a very different role, and you need to figure out how to make that transition. It took me actually 2 years to figure that out, and change your thinking on how to invest compared to how to operate a company. But after I figured that out, how I would kind of approach investing over operating, I really enjoyed it, and made it then later on kind of my full-time career by raising a fund and committing to it for a longer period of time.
So what was the first startup that you invested in?
So the first startup was something I actually didn't want to invest in, but I still did. It was Indochino, which has become a really successful company over time. And it was a really small investment, $10,000, very early on, basically on a business plan, which I rarely do today anymore. But they were two impressive UX students, and the four of us got together and invested $10,000 each, and it has become a company that will do over $25 million in revenues this year, and employs over 100 people between Vancouver and Shanghai. So super successful e-commerce company, and really proud of that first investment. If my track record after that would have been as good as the first investment, but it's a little bit like playing golf. Your first round of golf is always the best. After that, kind of it goes down.
So what happened after that? Tell me about that.
No, I mean I think as an investor, you there's a few things. Investment success, I mean, there's a lot of luck. In the end, when you look at kind of returns for angels investors, it's never the average, right? It's usually you have out of 10 investments, you have 3 that go bust and go away. There's three that that perhaps pay back your money. Somehow you get a little bit out of it. There's three that do reasonably well, like 3 to 4x, and then there's one, hopefully, that does 10, 20, 100x. And the challenge is that usually 10 is not even kind of the right portfolio size. You probably need to have 30, 40, 50 investments to have a chance to get that one that really takes off. And so from that point of view, it's all about having a pretty large portfolio and having a chance to get one of these really big winners, billion-dollar companies in your portfolio. I think the second thing I have to say is like, I'm at it now for 5 years between angel and VC, and I would say I'm still learning in terms of understanding the kind of entrepreneurs that can create big companies, the kind of business models that can turn into billion-dollar companies, the kind of time you need to have to invest at the appropriate time, in the right opportunity. And then last but not least, it's in the end, it's all about deal flow. I mean, what are the things that you're seeing? How many startups do you see? How many high-quality startups do you see? And that's usually a thing that that develops over time. In the beginning, you only invest locally, then you expand your reach. You invest in Seattle and perhaps Western Canada, and over time, you kind of get broader and broader. And by now, I kind of invest across North America and have started to see really unique deal flow that I really haven't seen after that. So it's luck, it's timing, it's about deal flow, and it's about developing your own investment thesis over time and getting better at picking the winners. But having said all that, it's if any investor would be perfect at it, right? They would dominate the market, and it's just not the case, right?
Yeah.
So.
What would you say the difference between entrepreneurs 15 years ago versus the ones today?
It was much easier to be an entrepreneur 15 years ago.
Really?
Yes. I think that. So I think there's two things happening. On the first, on the one hand side, I think it's there's more opportunities ever for being an entrepreneur. It's so much easier to create a company, way lower cost. I mean, when we started our startup, out of the first $750,000 that we raised, about a third went into hardware that we had to buy to just host our servers. I mean, today people don't even think about buying hardware anymore. I mean, it's like, yeah, you go to Amazon and host it, right? It's not even a factor. There was no standard software, so everything that we needed to do needed to be created from scratch, right? Which was hugely costly. There was no efficient marketing that you could do. I mean, the only thing was print ads or buy a banner on the homepage of Yahoo, which at the time was kind of the prime search engine, and the only thing at some stage they could target that banner based on keywords of the categories people were looking at. So that was kind of the targeting that you had 15 years ago. So really rudimentary, really costly. At the same time, because everything got so much cheaper, you have so much more competition today. So 15 years ago, you probably had about 1,000 to 2,000 startups that were created every year. Today, you have about 10,000 startups that are being created in North America every year. At the same time, you still have the same amount of 10 to 15 companies in North America that become billion-dollar companies. So you just have a much larger funnel on the front end, but then financing after that is still financing opportunities are still the same. So that's why we're suddenly talking about a Series A crunch, because there's way more startups that got funded at the front end, but institutional investors are still investing in appropriately, kind of approximately the same amount of startups at Series A, and down in the funnel you still have the same 10 to 15 billion-dollar companies every year that come out of that funnel. So it has gotten so much easier, but at the same time it has gotten so much harder kind of cut through the noise and become one of these startups that gets institutional funding and can kind of really scale. I always joke about it, but I don't think I would get any money today. You know, bad profile, kind of business background, not a developer background, right? When we did 8 books, you only had a business plan, no product out there, no traction. You know, everything kind of investors ask of entrepreneurs today. Now show me your product, show me your traction. We didn't really have it at all. We were actually 4 business founders and 1 dev guy. Today you'd say, oh God, I mean you want to have max 1 business guy in there, but you want to have 4 people that can actually build product. So I was kind of lucky that I did all that 15 years ago. Today I probably wouldn't have any chance. I wouldn't fund myself anymore.
Uh-oh. What would you say some of the biggest mistakes that entrepreneurs are making today versus what they were making when you first started investing? Are they the same, different?
No, I think people are underestimating kind of what it takes to really cut through that noise, right? I think great product is always the a great starting point and a must-have, but to really cut through the noise, my rule of thumb is for every startup that is doing something today, there's probably about 10 other startups that are doing something similar or somehow competing with you for attention for the users, and it's really tough to get cut through that noise. When you look at it from a consumer perspective, and you look at the average consumer is only using 8 to 10 websites or apps on a regular basis, right? So the question is always how can you even cut into these 10, right? And out of these 10, there's Google and there's Facebook and there's Twitter and there's Skype and all of Dropbox, all of services that you use on a daily basis. There's no freaking way that you're going to replace them. So how can you get into that top 10 list of a consumer? And entrepreneurs just underestimate the amount of hustle and persistence and aggressiveness and growth orientation it takes to really cut through that noise and become one of the companies that makes it.
Are there any strategies that you found that entrepreneurs have been able to cut through that noise?
I think it's about 2 things. I mean, the first one is you need to be ahead of the curve in terms of the product you're developing. I mean, when you look at the really successful companies, with very few exceptions, right? They were very innovative, and they weren't any Me Too products, and they really were ahead of the curve, and they built kind of the traction when nobody was even thinking about that market, right? The second thing is, from the beginning on, think about distribution and think about how you can grow it, and this really needs to be part of the founder DNA. You can't just hire a growth hacker to help you grow the company. I mean, that needs to be part of the founding team and how they think and how are you actually going to really grow this company? Is it virally because you have a product that is good for that, or is it a real social product, or is it going to be SEO, or do you have a large enough lifetime value for your customers that you can actually invest in paid marketing, whatever it is, right? But you need to really think that through from the beginning on.
Yeah, for sure. How have you changed as an investor over the last, you said 8 years that you've been investing now?
So I think there's a few really big changes going on in venture capital, and I mean, just to name a few, I think there's a big trend of smaller funds. So 10 years ago, usually the smallest funds were $100 million, and it went up to $2 billion. Today, the smallest, there's dozens of really small funds like my own fund that are in the range of 15 to 25 to $30 million. They write smaller checks, they act much faster, they execute really fast. So much smaller funds that can write smaller checks and run really fast. And the second thing is, 10 years ago, most of the VCs were people with a financial background, so former investment bankers, consultants, bankers, and that has really changed. I mean, when you look at kind of some of the most successful firms that came onto the scene in the last little while, it's usually all run by former entrepreneurs that turn investors. You know, Andreessen Horowitz, which is probably the most successful and prominent firm right now in the Valley, just came onto the stage about 3 or 4 years ago. Seven general partners that can make investments, all former entrepreneurs, right? You look at any of the smaller funds like the one I run, almost exclusively run by former entrepreneurs. So I think kind of operating experience is really important. And then I think out of all of that, I think entrepreneurs that have created great companies have a much higher leverage today over who to take on as investors, and if they want to take on investors, then at all, kind of that they had 10 years ago, right? I mean, I think 10 years ago, because everything was much more expensive, you basically had to take on venture capital to build a big company. Today you have companies, that do tremendously well, that are very profitable, that never really took on venture capital. I mean, you look at here, Plenty of Fish in Vancouver. Marcus still owns 100% of Plenty of Fish. It's a company that's usually profitable and growing like crazy, and he never really had to take it. Club Penguin sold to Disney for $350 million. Never took on a dime of venture capital. So I think if you have the right business model and you're in the right vertical and you execute really well, you don't even have to take on venture capital, and that certainly changed the dynamic between investors and entrepreneurs.
Yeah, sure. So you, speaking of version 1, because you bootstrapped Media Ventures, right?
Yeah.
What made you decide to take on capital and actually make that jump from an angel to a VC?
It was a really long decision, and something I kind of took some time with. When you get into the VC business, and just a little bit of background, what you do, you basically raise funds from investors called limited partners, and a fund usually runs over 10 years. So you give a commitment to these investors that you're going to invest their money and manage the money over the next 10 years. So when you do that, you certainly, it's not kind of a quick in and out. You basically commit yourself for a pretty long period of time. So the commitment to a certain career is the one thing. I think the second thing is it's much easier to lose your own money than to lose other people's money. So there's an additional layer of pressure if you invest other people's money instead of your own. I think on the upside, it really allows you to do, or for me it was kind of two key arguments for doing it. The first one is I was able to write much larger checks. As an angel, you might write $50,000 checks, $100,000 checks. As a VC, I can invest now up to $1 million, $1.5 million into one company if it does really, really well. So I think you can not only write bigger checks in the beginning, but then also kind of continue to invest in a company that does really, really well and protect your ownership stake. The second thing is it really makes you more disciplined around investing. The biggest challenge is just for us, for every 100 deals we see, we only make one commitment, and we have to say no 99 times, right? And I think if you went out there and promised investors a certain return, a certain investment thesis, you're much more disciplined to sticking to that than when it's your own money and you kind of say, okay, this time I'll make an exception. I really like the entrepreneur. I really like the opportunity. So I think it makes you much more disciplined to invest other people's money besides your own.
Yeah. Just from your track record, you tend to invest in B2C companies versus B2B companies. What's your reasoning behind that? Is it just the entrepreneurs, or?
So I think in the beginning, I exclusively invested in consumer companies, and it was just from the background what I had learned. I think in the meantime, I have done quite a bit of software as a service investments. I think I have now 6 or 7 B2B companies in there. What I'm trying to avoid is investing in B2B companies that have large enterprise sales teams. So when I invest in software as a service startups, it's usually companies that have a very scalable distribution channel through inbound marketing or paid marketing, etc. So here in town, I'm invested in Clio, which is in the legal space, Unbounds. I'm invested in an admin company called Jobber. So I'm doing increasingly more in the B2B space, but traditionally I have been investing more in the consumer space because it was closer to what I had learned and kind of where I had experience.
Yeah. Are there any Vancouver-based startups that you passed up on investing in that you regret?
Yes, there were 2 actually. So I passed on probably the biggest mistake on Hootsuite at valuation was roughly $3 million, and as you guys know, today it's kind of last financing round was at 200. So
why didn't you?
Would have been a good investment, but I didn't, and I would still take the same decision. And I think that's what you have to live with as an investor. You're always going to have what we call the anti-portfolio, things that you passed on, but you shouldn't have. But for me, the 3 reasons why I didn't invest in Hootsuite at the time, and again, going back to those reasons, they would still hold. The first one came out of an agency, and my experience of teams that come out of an agency has been mediocre, just because it's a lot of you still have a fallback option of going back to your consulting project. So I feel like the entrepreneurs often are not super committed. They kind of think about the upside and say, listen, if that's really going to take off, we're going to spend a lot of time on that. If it doesn't really, I can still go back and do my consulting agency stuff. So I feel like you're not with both feet into the risk, right? So that kind of was my first problem. The second problem at the time, I didn't really invest in B2B startups, and Hootsuite while it was a consumer product, all of the monetization was meant to happen on the business side, and it was just not part of my focus at the time. And then the last one, I felt like they were super dependent on Twitter, and I felt like at some stage, whenever your startup is depending on one platform that might or might not cooperate over time, you have kind of a single point of failure that might kill your startup, right? So at the time, I felt like all of these reasons just led me to believe that it wouldn't be a good investment, which was clearly a bad choice. And Ryan and team have done a tremendous job building up that company. It's kind of, as we all know, one of the most successful companies in Vancouver. So yeah, I mean that was my first one. The second one was Clio, which I invested later on, but I passed on as an angel. Again, I should have invested.
And you sit on the board of Clio and Enochino and Hootsuite 101?
Yeah.
How are you finding that? Your position changed over the years?
Yeah, I mean, I think the one that is probably the most interesting is, for me, it's Enochino, because I've been sitting on the board for 5 years, and it was, in the beginning, it was like this tiny startup that tried to find product market fit, and today it's a company that has raised close to 20 million now, is expanding really fast. So very different conversations that you have at the early level compared to now. And there might well come the time where I'm not the appropriate person anymore to sit on the board, because you need big company guys and not kind of a early stage investor anymore on the board. But that has been definitely the most interesting experience in terms of how a company evolved and has changed over time.
So to startups who may be looking for investors who would also sit on the board, what would be your advice to them?
For startup investors? You know, I mean, I've changed my opinion on that over the time. In the beginning, I basically joined the board of any company I invested in kind of a significant amount of money, and felt that in the end, it probably wasn't really necessary. I feel in the really early stages, up to a Series A, you probably don't really need a board. It's board kind of formal board meetings every 6 to 12 weeks are probably not frequent enough to guide you through that first 18 months where you have quick iterations, you try to find product market fit, you have continuous fires to put out. So I feel in the meantime that for me personally, and that's probably might be valid for other people, is if you invest in the right entrepreneurs that know how to reach out and when to reach out, and with whom you have a really good relationship, there's no need for a formal structure like a board in really early stage situations. Later on, that Series A, different story, but in really early stages, probably no real need.
Makes sense. What's the most interesting startup you've invested in?
It's a really tough one, but I would go with 3 choices. So the first one I'm just super excited about, and it continues to evolve at rapid pace, is Indiegogo, which is a crowdfunding website. I was one of the first investors when nobody really talked about crowdfunding, and they've just carved out while Kickstarter is doing really well on tech products and music and films, Indiegogo basically stands for all of the rest. And there's such tremendous opportunity that I had never really thought about beforehand. I mean, it's everything from when we had these protests going on in Turkey that people raised money on Indiegogo for a full-page ad in the New York Times to kind of communicate what was going on, to here the Toronto mayor that people raised money on Indiegogo to buy that crack video, to here like a super successful new restaurant here in Gastown called Besties. It's a currywurst, actually a German kind of wurst. They opened it up and they raised $13,000 on Indiegogo to open up their restaurant and etc. So it's a really powerful concept for a lot of things. If that is political reasons, non-for-profit reasons. I sit on the board of Science World, and they just recently used Indiegogo to raise funds for a new exhibition, and did really well. So I think democratizing funding and making it more transparent and having a wider reach is a huge concept. The second startup I'm super excited about is Flurry. Flurry is a mobile analytics startup. It's kind of the de facto standard if you build a mobile app. And it was a startup that in 2009 was almost dead. The investors kind of put in a little bit more money, but nobody was really excited about it. And suddenly they figured out how to make money on an ad network. And is probably my fastest growing startup and might even go public in the next little while. So really interesting company. And the last one is a Canadian company called Wattpad. Wattpad is a Toronto-based company. They basically a platform for sharing stories, and it's really disintermediating the publisher, because it's in the end it's connecting writers with readers on a social platform. So there's writers on there that have never published a book before, but are just great storytellers, and they have hundreds of thousands of fans on Wattpad that follow them, follow the daily episodes, and it's just creating a new way to connect writers and readers, mostly through mobile, so people really reading these stories on their mobile phones on the way to work. It's exciting to see that in a very traditional industry, and I've been part of the book industry for a long period of time, that there's something that is that revolutionizing and kind of creating completely new connections.
Is there something that you're seeing consistently across the board with these startups that you're investing in that is really working well?
I think whenever you have a network effect kicking in, and not every model has that. I mean, there's e-commerce is not qualified for that, or software as a service. But if you have a marketplace and a platform, and you have this network effect kicking in, I mean, it's just that moment when that happens. I wouldn't say it's only success from there on, but you have such a great likelihood that you're going to build a really big company. So it's a beauty to watch that. Having said that, it takes a tremendous amount of time to get to that point. I mean, Wattpad, after 3 years, they had 300,000 uploaded stories. Today, they get 300,000 uploaded stories on a daily basis, right? But it took them 3 years to get to 300,000 total uploaded stories. Indiegogo, it took them 3 years to really build up a little bit of traction and really get somewhere. To get to that moment where the network effect kicks in, it takes a long time, and it's tough as an entrepreneur to hang in there and believe still in your concept and believe that you're still gonna see it one day, because at that time it just doesn't show in the numbers.
Yeah. Is there like a big lesson that you've learned from your investing?
Yeah, I mean, I think it's two lessons. The first one is it's all about the team. Never fall in love with the opportunity. It's all about the team. It doesn't matter how well a startup does today. If the co-founders don't get along, or they don't complement each other, or they have hired weak people. At some stage it's going to punish you, right? You need to take it to the next level, and the founder team doesn't recognize it. So in the beginning I always thought it's probably 50% traction, 50% team, and today I think in the early stages it's 98% team. And traction is just a reflection of how good that team is. But if you're not in love with the team, you think these are stellar entrepreneurs that are committed to the long term, have a big vision, are really passionate about what they're doing, are smart, are hardworking, then you better don't invest. And I think it's something that I've learned the hard way over time. And the second lesson learned is man, this is so much about luck that I think it's you should never overestimate successes and failures, because and take it too personally as an entrepreneur as well as an investor. Sometimes it's just you had a great idea, or you were just a little bit too late or too early in the market, or something happened that shouldn't have happened that you didn't expect. It's sometimes interesting to see how it's playing out, and there's a lot of factors that impact your success that you have no control over. So luck definitely plays a big role.
You really like data. Can you tell us a little bit about why you like that so much, and what you think about data-driven startups?
I think in the end, I think great startups are created in a combination of a big vision with a tremendous understanding of the different levers you can pull, and how you can really fine-tune the model that you're doing, that you're running on a daily basis, right? And data just gives you the signals where you should spend your time on, right? And I just feel that not every entrepreneur kind of uses data in the way they should be using it. And there's certainly a time in the really early stages, product market fit, don't use too much data, because I mean, in the end, you don't even know what you're testing against. You haven't really found your product, you haven't really found your customers. But once you reach some scale, somebody that has a SaaS startup and doesn't know kind of what his churn rate is, what his sign-up rates are, et cetera, somebody that runs a marketplace and doesn't have his code analysis with him, it's just usually it's an expression of not caring about the details and not wanting to use data to really understand where you can, how you prioritize the most scarce resource you have, which is your time. So I just feel like any entrepreneur that doesn't use data just signals that he's probably not fully into improving the business and himself on a daily basis. And so from that point of view, I'm just a big fan of data, both to improve the business, but also signaling from an entrepreneur about what he cares about and what he doesn't.
Cool. And last question, what would you say to startups that are looking to get funding from a venture capitalist or an angel? How would they go about doing that, whether it's you or somebody else getting in touch?
So I think a few things. I mean, the first one is, and it probably goes without saying today, but you need to have a product in the market, and you need to have first feedback on that product from users. And I think today, I think nobody really wants to go through a big business plan anymore. It's like, hey, listen, this is a big market, and I asked 50 people on the street, and they really liked the product and would buy it and would pay X dollars for it. I mean, in the end, the proof is in the pudding. It doesn't cost a lot to put out a product, and at least an MVP, and you should really do that before you even think about raising money. I think the second thing is, there's this saying, you ask for money, you get advice. You ask for advice, you get money. I think one of the best thing is if try to understand what the investor is interested in and what are some of the themes that he really cares about, and then engage him in a smart, intelligent way in that early enough before you even look for money, right? If an entrepreneur comes to me and says, listen, I'm not looking for money right now, but I want to get your feedback, and it's a market that I'm really interested in, and I want to learn about it because I want to understand it better. Think about it, investors, we're trying to understand hundreds of different sub-markets and business models all the time. So for us, we're trying to get as much data as possible to sort our own thoughts, right? And if there's an entrepreneur that can really educate me and I have a really smart discussion with him about it, I go out of that meeting and say, I learned something, the entrepreneur learned something, and kind of was the start of a really good relationship. And then that might or might not end up in a funding event down the road, but you probably have a much higher likelihood than some of the guys that sat in my office or sitting in my office probably every week that say, listen, we have this bridge round that we need to close within the next few weeks. I know, we haven't met each other beforehand, but what do you think? $100,000, but we need to close by the end of the week, and you also get a discount of 20%. And it's like, that's not the way you do investing, and that's not the way you should do. You should try raising money. But it happens all the time that people think about money raising the moment they really need it and they run out of money, instead of building long-term relationships with investors. Again, worst case scenario, you don't get the funding, but you learn something from the investor. Best case scenario, you learn something and you get the money. So
great. Well, thank you so much for coming. We'll open it up to any questions you guys have now.
Yeah, I raised money. I'm probably one of the few people here who raised money in the 90s as well. And,
good for you.
And sold a company in 2000. But it seems much harder. I'm out with another startup. It seems much harder to raise money these days. It seems like there's two factors. There is a lot more competition from a lot more smaller companies. But it seems like there's less money out there than there was in the 90s. Certainly post-2000, there was a big drought. And even today, though, it still feels like there's less money for tech out there.
I think it's less money on the early stages. When you look at any of my companies that have gone past Series A and do really well, they get so much inbound interest from US VCs, often 4, 5, 10 VCs that participate in a funding round, right? The challenge is really on the early stages. When you look at Vancouver, there was a pretty active angel kind of syndicate or kind of ecosystem about up to 5 years ago. A lot of people that had made money in tech beforehand. Unfortunately, all of these people, or a lot of these people, lost a lot of money in angel investing after that, and they are all out of the market. And when you look at the new generation of entrepreneurs, they haven't really had any big exits, right? I mean, there's a few really good web companies coming up. You know, we talked about Hootsuite and Clio and Indochino and Bounce and Coastal Contact and Build Direct. I mean, there's a few of those, but a lot of these guys haven't really had tremendous exits, so they're not yet back as angels. And you look around, I mean, I couldn't name you a single angel that has invested in, you know, at least 2 or 3 deals a year in the last 3 years, right? Yeah. So that's really the challenge. You know, seed and probably also Series A. Once you're beyond that and you're successful, I mean, there's a tremendous amount of money available. But beforehand, I agree. I mean, there's just no network to speak of.
Yeah, we finally raised about $250,000, but it was almost friends and family. It was all people who'd invested back in 2000.
Yeah.
That's pretty long.
Yeah.
People we played.
Yeah, and you know, if you try really hard, I think there's these people out there, but they're not really known people. I mean, you basically have to go to your personal network. You have to ask around. It's really painful and long and slow as a process.
Great. In the back there.
Do you think the risk of Twitter severing Hootsuite's API has passed?
No, I think it's much smaller, right? But you know, Twitter in the past has not, I mean, like any platform, right? I think whatever a platform says about how they love the developers and the people, you know, disputing through it. I mean, if you look at Facebook, Amazon, Apple, Twitter, they all screwed the developers and their partners at some stage. And if I was running the platform, I probably would do it as well. I mean, it's in the best interest in the long run that, you know, you let these guys figure out what really works, and then either you do it yourself and just say, oh, sorry, you can't do that on our platform anymore. It's now something that we do ourselves. Or you really tax it in a big way, right? Like Facebook, 30%, Apple, 30%. Look at Amazon Marketplace. Great way to decide your merchandising priorities. Whenever there's a third-party seller that sells tremendously well on Marketplace, you know, the merchandiser looks at these numbers like, interesting, I should put some in stock. Looks like this model is selling really, really well. And then, you know, next thing that this third-party seller sees is like sales drop because Amazon is now selling it themselves and undercutting it, right? So I think it's really hard in the long term to win on a platform. You know, having said that, I think Hootsuite is now much broader in terms of reach, and you know, between LinkedIn and Facebook and Twitter, and it doesn't feel like, you know, social media management is necessarily something that Twitter is interested in controlling. So I would say the risk is not gone, but the risk is much less than it was, you know, 5 years ago.
Great. Okay. Yes?
How would you recommend a startup determine their pre-money valuation, and what factors would you suggest they look at?
You know, it's a tough question, right? It really depends on so many factors, right? I mean, in the end, it's the market that decides. I mean, I've been part of seed rounds that had $1 million pre or even less, right? And I have been part of seed rounds that had an $8 million pre, and you know, my returns might have been better on the $8 million pre than on the $1 million pre, right? In the end, it's what the market looks at, the potential of that company or that founding team be. But in the end, there's, for any funding round, there's, for me, there's kind of a few rules of thumb. I mean, first of all, I think it's probably realistic to give up around 20% of your equity in each funding round, so between 15 and 25. The second thing is whatever you raise should last you at least 18, if not 24 months, so you get to the next milestone. So you can execute for 12 months, get traction, and then go back to the funding round. So, you know, if somebody comes to me and says, listen, you know, we want to raise $200,000 on a whatever $8 million pre, then that doesn't seem to make sense, right? In terms of way too less money probably for way too high of a valuation, so something doesn't make sense. So I think that those rules of 20% per dilution per round, and it lasts you at least 18 to 24 months, kind of gives you a certain rule of thumb. But in the end, it's the market that decides that, right?
Yeah, Tony?
If you were to make a guess on how the ecosystem is going to change over the next 12 months.
In Vancouver, the ecosystem?
Not necessarily overall, but Vancouver specifically.
I think it's a really interesting time right now, that I think we have kind of a major theme missing right now. I mean, probably 5 years ago it was all about social, right, and Web 2.0. I think that the social wave has probably played out to a large extent. We're now starting to look more into verticals, etc. I think 2 years ago everybody would have said it's mobile is the big one, but when you look at kind of the mobile winners today, it's mostly incumbents that have done really well, except besides a few exceptions. But it's basically the Amazons and the eBays in commerce, the Facebook and the Twitters in social networking that are kind of the dominant mobile social networking place. Or mobile commerce place. I still think that there's probably going to be, we need to see more innovation around mobile. I recently was blogging about rethinking the mobile use case. I think in the same way that when you think about banner advertising in the beginning, it was basically what people knew from print. They basically adopted to online. It was basically, I know how advertising worked in print, and now I just do it online in a different medium. And then Google really figured out what the most profitable advertising model was in online, which was search engine. I think we're probably in the same stage for mobile, where in the first phase was all of the incumbents basically just porting their web product into mobile and being pretty successful at it just because they had a critical mass already on the web and just did slightly better mobile products or adapted mobile products. But really rethinking that use case of mobile. There's a few things that just intrinsically can be better, made better on mobile. Instagram was certainly photo sharing is one of these things. I talked about the startup that I invested in, Jobber, which does business management software for the field services industry. So painters, landscapers, gardeners, etc. that are on the road the whole day, going from job to job, and basically they do it mobile first. So before you managed your business once you came home from your jobs, and you sat down at your desktop computer and sent out invoices and recorded your next jobs and scheduled your next appointments. Now you do it all on a mobile phone while you're on the road. You immediately issue an invoice to the customer and take payment by swiping the credit card after your job. You immediately schedule the next appointment. Then the mobile app tells you how to get to your next appointment and to your next job. So I think there's a few of these use cases that are mobile first, mobile native, and I think entrepreneurs have to get more imaginative about what exactly those use cases could be and what exactly those verticals would be. So if I had one bet in terms of what you're going to see, it's probably going to be more development in mobile, more innovation in mobile.
How do you recognize a great team?
A great team. I think there's a few elements to it. The first one, I always like it having very complementary talents. So you have really good developers, you have a good designer, and if you're dependent on sales and marketing in a heavy way, then you probably have somebody on board that really understands that as well. So complementary talents is the one thing. The second one is, for me, it's team dynamics. And there's sometimes you have 2 or 3 equal founders and they don't even decide who's CEO, they're just founders, and you feel like there's enough gel that that kind of keeps them together, and they trust each other, and it works. And sometimes you have a clear hierarchy of somebody's the CEO, but you feel like they can work together in whatever model it is. They work together. There's no tensions between the team members. So that's definitely some of the things. And then I think something that holds for if you're a sole founder or a team, it's in the end three things. Do you have a very clear vision where that can go, and you can describe it very quickly, right? And in one or two sentences where you want to go. Secondly, you send the message that you're in for the long term. There's no backup plan. This is what you're going to do. You're going to succeed, right? If somebody comes in and says, no, I'm going to do that if I raise the money, it's like, that's the wrong approach, right? I mean, if you really believe in that idea, but stupid investors just don't believe in you, then you're going to show them. I mean, you're going to bootstrap it, and you're going to make it, right? But if you need the money in the first place, then that's kind of wrong signal. And the third one is like, if people are really, really passionate about what they're doing, they can talk about it for hours in a good way, not in a don't listening way. But they know about every single detail. They're passionate about it. They can talk they talk on a party about it. They love discussing it with you, and you feel like it's not they pitched that to you because they just want to be entrepreneurs and that was the best idea they had. But they're really passionate about solving that problem for a certain group of customers that perhaps is equivalent to what it's basic for them. It's a pain that they feel themselves, and they want to solve it for themselves, and they're really passionate about it.
Great. So we'll leave it at that for today, but hopefully Boris will stick around. If you guys have any other questions, you can approach him, and yeah, thank you.
Thank you.